Have you ever wondered how central banks, like the Federal Reserve in the United States, subtly steer the economy without directly telling businesses what to do? It is a fascinating dance between policy and market forces, and it all starts with a very specific, powerful tool. Open market purchases are the primary method by which a central bank expands the money supply. This crucial process involves the central bank buying government securities, such as treasury bonds, from commercial banks and other financial institutions in the open market. The immediate goal is to inject liquidity into the banking system and influence short-term interest rates. The fundamental why behind these purchases lies in monetary policy. When the central bank buys securities, it pays for them by crediting the reserve accounts of the selling banks. These increased reserves give banks more funds available for lending, which in turn typically leads to a decrease in the federal funds rate, the target rate for overnight interbank lending. By lowering this benchmark rate, the central bank aims to reduce borrowing costs throughout the economy, encouraging businesses to invest and consumers to spend, thereby stimulating economic growth and employment. The process begins with the Federal Open Market Committee, or FOMC, setting a target for the federal funds rate. To achieve this target, the central bank's trading desk, often at the Federal Reserve Bank of New York, conducts daily operations. It announces its intention to buy a certain amount of government securities. Primary dealers, a select group of financial institutions, then submit competitive bids, offering to sell their securities to the central bank. The central bank accepts the bids that offer the best prices, and the transaction is settled, with reserves flowing into the banking system. A key insight into these operations is the distinction between temporary and permanent purchases. While outright purchases of Treasury securities are permanent additions to the central bank's balance sheet, many daily operations are conducted through repurchase agreements, often called repos. In a repo, the central bank buys securities from a dealer with an agreement that the dealer will buy them back at a specified future date and price. This allows the central bank to temporarily increase or decrease reserves, offering precise control over short-term liquidity needs. Ultimately, understanding this process reveals how the central bank maintains financial stability and guides economic activity. By strategically adjusting the volume and type of its open market purchases, the central bank fine-tunes the money supply and interest rates, providing a powerful, yet indirect, mechanism to foster economic health and achieve its mandated objectives like maximum employment and price stability.